In the 1960s and early 1970s, a lot of young economists like me studied whether the demand for money function was stable, and generally we found it to be so. I had a paper in the Bank of England Quarterly Bulletin in 1970 called The Importance of Money. David Laidler had a textbook called The Demand for Money. And so combine that as stable demand for money function with Friedman's argument that inflation is always and everywhere a monetary phenomenon. And there was a clear move towards the adoption of monetary targets during the course of the 1970s. This reached its absolute peak at the end of the 1970s and beginning of the 1980s with the Volcker measure that John has just talked about and the medium-term financial strategy. But by the end of the 1980s, monetary targets fell out of general usage, and into the 1990s and subsequently, they simply got abandoned by all the central banks, and they haven't come back again. And I'd like to try and explain two reasons why this happened. One reason, I think, was a bad reason, and that was that the main thrust of monetarism came from the US monetarists, and they were, as John has put it, narrow monetarists, focusing on the monetary base. For example, the Friedman and Schwartz great monetary history of the United States was largely structured around developments in the monetary base multiplier. The problem with the monetary base multiplier was that the central banks, as a generality, have actually virtually never set the monetary base. Instead, what they set, as you know, with the FOMC, the Bank of England, the ECB and all, is that they set interest rates, and they always historically have done so. When eventually, and it took rather a long time, everyone came to realize that what the central banks were setting was interest rates rather than the monetary base itself. Then the argument was that the monetary base was a dependent variable. And if the monetary base was a dependent variable, you didn't have to worry about it. And effectively, the money stock itself became a dependent variable, particularly if you used narrow monetarism. Now, the problem with that is manifold. The first one is that the demand for money is a function not only of the interest rate set by the central bank, prices and incomes, it's a function of returns, expected returns on virtually everything. Because you go from money into all other assets and all other goods, as Milton Friedman himself indicated quite clearly. So that simply saying that the central banks set interest rates, not the monetary base, doesn't mean to say that the monetary base cannot be affected by a whole lot of other factors. And indeed, one of the great advantages of broad monetarism is that you can look at the factors on the other side of the bank's balance sheet and look to see what is happening to the credit components. And you can easily get occasions where various factors on either the public sector or the private sector side can lead to an expansion of money. And yes, that in turn will lead to an increase in nominal incomes, and it will inflation and lead to an increase in the change in interest rates. So that yes, the monetary base and the demand for money are dependent variables, but they adjust to the factors determining them with quite a lag, and there can be many shocks affecting money that take time to work through the system, as John effectively has described admirably. So that the argument, which became generally sort of accepted in the US, unfortunately, that you don't have to worry about money or the monetary base because it's a dependent variable, really doesn't and should not hold water. But the second argument and the second reason why the monetary aggregates fell out of general usage by central banks in setting monetary policy was that the demand for money functions, which we'd all studied so assiduously in the decades before, tended, particularly after the monetary targets had been established, not to operate, not to react in the way that we thought. The demand for money function was much more variable than we had initially hoped. There's a phrase that Governor Bowie, the governor of the Bank of Canada at the time, which had a lot of influence. And it went something like this. We didn't abandon the monetary aggregates abandoned us, by which was meant that the monetary aggregates behaved in ways that really hadn't been entirely expected or predicted. In particular, in the 1980s, for a variety of reasons, inflation came down to the kind of levels that was desired, but the monetary aggregates did not behave in the way that had been expected. I could go into some of the reasons why that might have been so. And the narrow-based M0 monetarists, again primarily in the US, had a further sort of disaster when, after the change in the structure of determining the interest on short-term government debt, from running from a corridor to a floor system, the monetary base expanded dramatically in the years 2009 to 2011, from the exact years. And many of the monetary-based monetarists sent public letters saying that this would cause massive inflation. And of course it didn't. And that goes back to one of the issues that, again, John has talked about, which is that given that the demand for money function is very variable, you cannot easily set a monetary target because the monetary structure is changing continuously and is changing at the very moment with stuff like stable coins, central bank digital currency, CBDC, etc., etc. There are all kinds of changes. Again, there's different development of near monies, money market funds, and all of that. And so the very definition of money is a difficult issue. And that brings me to the second main heading that I have in my one-page slide, which was, how should we now interpret the monetary aggregates, given that the demand for money function is pretty variable, and you don't actually frequently know exactly what money is, because it's always changing. It's the monetary and the financial structure and the banking structures of our countries are changing, and they're changing very rapidly at the moment. Now, my particular preference for trying to see whether the monetary aggregates are growing too fast or too slowly is actually a monetary aggregate that I don't think John has yet mentioned, which is divisio money, which tries to weight the various elements of money by the interest rate that they bear. Demand deposits used to have zero interest rate. Now they have positive interest rates in many countries. Time deposits, certificate of deposits, maybe money market mutual funds, etc., etc. And I think that the evidence, the empirical evidence, shows that if you weight the money stock by its interest rate in the divisio money approach used by Bill Barnum and my friends in America, you get a rather better sort of feel for where monetary growth is growing a bit too fast or a bit too slowly. The problem with divisio money is you can't actually look at the balance sheet data of the banks and try and see what has caused the monetary growth to be a bit too fast or a bit too slow. And for that, broad money growth is actually far better, because you can look at the credit counterparts, as we did in the UK in many cases, with domestic credit expansion, etc., and see what it is that seems to be driving the faster monetary growth. So if you want to look at the causal structure of monetary growth, broad money is, I think, where you should go. But if you want to look at whether monetary growth is a bit too slow or a bit too fast, I would actually put more weight on the divisier money. Now let me turn finally to the final element of my one-page slides, which is, should the central bank seek to control the growth of the monetary aggregates? And I think the argument for the time being is certainly not have a target for it, but what you want to do, first of all, is to try and assess whether it is, to use John's accurate phrase, one that I strongly support, outside the guardrails. What you want to do is you want to have an idea, given what you expect in the central bank's forecast of interest rates, inflation, and real growth, etc., what you would expect monetary growth to be. And if monetary growth diverges too far from that expectation, say more than 2.5% in either direction, then I think that it's important to understand why. And it's the analysis that you need to do. And when you've done the analysis of what the reasons are for the growth of the monetary stock outside the guardrails that both John and I would like to see adopted, that is the next stage. It's not necessarily to change monetary aggregates alone. However, there's a final little kicker on this. The final little kicker is that we're getting to a stage where the fiscal position, the size of the fiscal debt ratio and the size of the fiscal deficit is so high that we're getting to a stage of fiscal dominance. Given fiscal dominance and the slow ability of the fiscal authorities and the governments to bring about fiscal sustainability, then we always hope, and we hope that Andy Burnham will actually move in the direction of fiscal sustainability. Looks unlikely to happen in either the US or France. There are two other cases. If we are in a world of fiscal dominance, then there will be very considerable pressure placed by the authorities on the central bank to keep interest rates down, because otherwise the fiscal position just gets worse and worse and worse. If the authorities are putting pressure on central banks to hold interest rates down, then there'll be a likelihood of an attempt to reduce monetary growth through other means. And that's actually where I came in a long time ago in 1974. 73 it was, when inflation pressures were rising very sharply. And as a result, the interest rate that the Bank of England set went from 6% in about June to 13% by the time we got to about November. Much faster and higher rate of growth, increases in interest rates than anyone has been thinking about now. And that nowadays it's extraordinary if the central bank raises interest rates by 50 basis points. Then we were quite happy to raise interest rates by 1 or even 2% at a time. You ain't seen nothing yet. But anyhow, come November 1973, the order came out from the politicians, Heath and Tony Barber, that we were to reduce monetary growth without raising interest rates any further, because they couldn't stand the heat. And that led to the development of something called the corset, which I actually designed. And one of the interesting questions that may well come up, if fiscal dominance becomes the norm over the next few years, as I think quite likely, might be what is the best way for a central bank to use instruments other than interest rates to repress monetary growth. And I think actually, we might return to something like the corset, but that's fortunately we're not there yet. So the central bank may be forced to try and control the rate of growth of the monetary aggregates because it can't. It may well be constrained in its use of interest rates. However, that particular problem, fortunately, is not yet upon us. So that's enough for me. In many ways, I share a lot of the conclusions that Alan has given you. Guardrails are desirable. If we exceed guardrails, the first thing to do is analyze why and try and think how best to restore the situation. And I'd rather hope that a guardrail type monetarist constraint will become utilized, possibly in the UK, possibly in a range of other countries, but not monetary, but targets. The financial system, the banking system, is just too flexible and changing just too rapidly, even to know exactly at any point in time exactly what money is. In the old days, too many textbooks used to use the word money as if the definition of money was self-evident. It isn't, and it won't be. And that's enough for me.